So now we're talking about the risk strategy and risk appetite statement, and they are a very crucial part of the risk management process in a bank, because the risk strategy it's the overarching document which lays down how the bank wants to do their risk management. And really what a risk strategy is it's a lot of text, or you can think of it is at every bank a 90-page document. And in this risk strategy, the bank first talks about its business model and which risks arise from this business model, right? For instance, you're a real estate bank, that means you need to think about certain risks, or you're more exposed to certain risk types. And this means that the risk inventory is also part of the risk strategy. So in the risk strategy, you talk about your business model, what risks are important for your business model, and this is where the risk inventory comes in. So you lay down every single risk type that is material for your bank. And then you come to the core part of the risk strategy, which is the risk appetite statement, or RAS, right? And the risk appetite statement is basically a table. It's half a page. And the risk appetite statement sets risk limits, right? And the risk appetite statements typically sets limits in Pillar 2, and limits in Pillar 1, and in Pillar 2. And here's how it works. So Pillar 1 basically tells you need to balance your risk-weighted assets and your equity, right? If you don't know what that is, look at my video about Basel III. And Pillar 1 basically tells you have a certain amount of equity, and this means that you can only afford a certain amount of risk-weighted assets. There's a simple formula telling you that equity divided by your risk-weighted assets has to be a certain percentage, right? And this percentage is individual for every bank, but it's usually about 14%, right? This means you can take your equity and you divide your equity by 14%, and this tells you how many risk-weighted assets you can spend. And what the risk appetite statement now does is it takes those risk-weighted assets and it specifies how many risk-weighted assets belong to which risk type, right? For instance, credit risk, market risks, and so on. So let's say your risk-weighted assets are at 100 million euros. So your credit risk might be 50 million euros, market risk might be 20 million euros, and the other risk types are chosen so that your limit is chosen is that your total limit is at 100 million euros. And what usually happens, and this is not part of the classical risk appetite statement, but it's also then detailed in the risk strategy, is which departments can spend the risk-weighted asset limit, the risk-weighted asset limit. So for instance, the retail department can spend 20 million euros, the corporate department can spend 20 million euros, and so on, and so on. Right? Let's quickly think about why this makes sense. So if, for instance, your corporate department says, I want to give a loan to a big company, right? And this loan is 100 million euros, and the company has a certain risk of default or not paying back the loan, right? Then, as I've explained in my video on credit risk, you can calculate risk-weighted assets for this loan, maybe 2 million euros. And so this means that your corporate department can only have 10 of such loans, because then they will reach their limit. So the risk appetite statement is a very important tool in managing how much risk or how much business is done within the certain departments and how much risk is faced by the bank. And this is something that you can easily report, right? So the chief risk officer will usually get a report which tells you where the limits are at and where the limits are close to be breached and where the limits are breached, which typically does not happen. Right? And maybe short, this is the Pillar 1 risk appetite statement. So this is part of Pillar 1 risk management because it talks about risk-weighted assets. Of course, the same thing is done for Pillar 2, right? So in Pillar 2, you say that your equity needs to be covered by your economic capital, and economic capital can be once again divided into credit risk, market risk, operational risk, and so on. Yeah. So this only as a side note.